Hello, everyone. Thank you so much for being here today. We're going to talk about asset allocation, balancing your risks and rewards. Before we get started, let me dive into a quick introduction. My name is Zach Carruthers. I'm a financial advisor from LPL Financial, office of James Rockwell and Zach Carruthers. So if you haven't already, please download the interactive worksheet. If you're on the landing page, it's right above this video by clicking the button. If you're on YouTube, use the link in the description to get to the landing page where you can then download that worksheet. It will be advantageous just because this is going to be a more interactive discussion where you can use the worksheet as we go through this presentation. So now let's get started on why asset allocation is important and how it is designed to help you pursue your goals through the balancing of risk and reward. So here are the topics that we'll be focusing on today. And the goal is, by the time we're through with this presentation, you'll understand how asset allocation works and why it can be a very important tool in your investment strategy. You'll have more insights into different types of investments used as strategic tools for asset allocation, and you'll know how to calculate your own asset allocation. Again, this is all designed to help you calibrate your own asset allocation and investment strategy to work towards your financial goals. So first, let's review what is asset allocation and why does it matter? Well, asset allocation is basically the dividing of an investment portfolio strategically between different asset categories, such as stocks, bonds, and cash or cash equivalents. The mix of assets should be determined by your investment goals, your time horizon, and your ability to tolerate risk. So again, allocation should depend on your investment goals and timeline. The right balance may help you reach your goals sooner while managing risk. Simply put, asset allocation is a way to keep us from putting all of our eggs into one basket. This allows us to do a better job of balancing the potential risks and potential returns. Experts agree that it also can be one of the most important decisions that an investor can make. One of the most often cited examples of its power, that is asset allocation, is determinants of portfolio performance. This is a study done, and it was done in 1986 and updated again in 1991 with results that continue to be validated and referenced by financial experts. And in it, researchers studied data from 82 large pension plans and determined that the key driver in returns of those portfolios during the study's timeline was indeed their asset allocation. How those assets were allocated among different investment classes accounted for, on average, about 90% of their variability over time. One of the authors of the study, Gary Brinson, was interviewed in 2006 for Wealth Manager magazine. He summarized the research and confirmed that deciding which asset classes to use and what percentages of those asset classes to use had the biggest impact on portfolio returns in the study. He also said those conclusions have stood the test of time. So, of course, there's never a one-size-fits-all way to divide a portfolio between asset classes to achieve an investor's objective because of things like goals, timelines, resources, and circumstances can obviously vary. And while there are no guarantees for increasing returns or reducing risks, there are strategies with the potential to help you do both. There are a lot of investment options out there: stocks mutual funds, corporate bonds, municipal bonds, bond mutual funds, life cycle funds, ETFs, exchange traded funds, money market funds, and US treasuries. These options boil down to three basic categories, though: stocks, bonds, and cash or cash equivalents. These three classes come with different levels of risks and returns and react differently in various circumstances and timeframes. So as you can see here, this is the risk return potential, the graph on the right. And this is talking about how asset allocation determines about 90% of the variability in a portfolio's long-term returns. So again, risk versus return, you can see stocks, bonds, and money market instruments. Those are the three basic categories that we just talked about: stocks, bonds, and cash equivalents. Let's talk about these different asset categories. Simply put, a stock represents ownership within a company. A bond is essentially an IOU that a borrower, such as a government organization or a corporation, gives to an investor and promises interest payments and then future repayment on that loan. Cash securities are short-term investments, such as treasury bills, that can be converted readily into cash, which is why they're sometimes called cash equivalents. Now, let's look more closely at each type of investment and refer to this chart, which provides context for how different categories performed between 1926 and 2015. This is what we refer to as the Ibbotson chart, named for the researcher, author, and university professor Roger Ibbotson. As an FYI, the initial investment for each of these investments in 1926 was a hypothetical value of $1. The green line, tagged here as Treasury bills, is helpful in representing the cash and cash equivalents category, including money markets. You'll see that the initial $1 investment had a compound annual rate of return of 3.4% and is worth $21 after 89 years. It barely edged over inflation, which averaged 2.9% during that same time period. Because it offers the least risk and the lowest rate of return, it may be appropriate for short-term goals or emergency savings. So next, let's look at the orange line, which represents government bonds. The $1 investment increased to $132, a 5.6% compound annual rate of return over 89 years. What's interesting about these green and orange lines is that neither one goes into negative territory, even after the major stock crash that helped launch the Great Depression. So I'm speculating here, but I think it's safe to say the orange line would have shown a higher compound annual rate of return if corporate bonds had been included. Bonds produce an annualized return of 6.10% over the 30-year period ending December 31 of 2018. This compares to 9.97% for stocks during that same period as measured by the S&P 500. Bonds, as an asset class, pose less risk than stocks and also offer a wide range of risk and return potential, ranging from the safest government-backed securities to high-risk junk bonds. Now, look at the black and blue lines, which spent a lot of time in negative territory during the Depression. The blue line, large stocks, showed an annual return of 10%, turning $1 into $5,390. Small stocks, which is the dark blue line, had a compound annual return of 12% during the 89-year span, ultimately turning the $1 investment into $26,433. So now let's look at the black and blue lines, which spent a lot of time in negative territory during the Depression. The blue line, large stocks, showed an annual return of 10%, turning $1 into $5,390. Small stocks, the dark blue line, had a compound annual return of 12% during the 89-year span, ultimately turning $1 into $26,433. Investors who aren't sure how or how much may want to consider investing in mutual funds, or at least exploring the option. Mutual funds make it easier for investors to diversify because they pool money from many investors and invest in things like stocks, bonds, and other financial instruments. The ultimate investing decisions are made by the professional fund managers. Mutual fund investments enable you to own a small portion of many different investments, helping you to balance your potential risks and returns. Losses on some securities can be potentially offset by gains made by others. Now, you need to know, however, that not all mutual fund investments provide automatic diversification because some focus on particular industry sectors. Choosing a mutual fund still requires attention to detail and/or research to determine if it's actually right for you. Request a prospectus from the mutual fund that you're considering and read it to carefully learn more about its investment objectives, its fees, and potential risks. Investment professionals can also be very helpful resources for helping you decide which funds to use. So now that we've looked into these different asset categories, which we consider to be the tools for your overall investment strategy, let's look at how you might combine them to pursue your goals. In a minute, we'll review asset allocations designed for specific goals. Before then, it would be helpful to take a few minutes to calculate where your assets are now. So what's your current asset allocation? Consider things like your retirement plans, your investment accounts, your bank accounts, and other assets to determine what your overall asset allocation should be and your asset allocation for each category. So if you would, get your worksheet out and please follow the instructions on worksheet 1, which is designed to give you an overview of your current allocation. You'll be jotting down your assets, such as your retirement plans, like we just said, your investment accounts and bank accounts. And please note where most of these assets are invested, whether it's mutual funds, stocks, bonds, cash equivalents, or other investments. So whatever your financial goals are, the time to start building or fine-tuning your strategy is now. Different goals may require particular investments, allocations, and timelines to achieve them. If you haven't already, start setting or confirming your goals. Determine your timelines for reaching them and consider how much, if any, you've already accumulated for those goals. Then ask yourself, how much risk are you willing to take along the way? Your earliest goal might be building an emergency savings in case you or a family member are in a serious accident or encounter or just other unforeseen circumstances. The latest goal in your timeline might be retiring comfortably in 25 to 30 years. Both of those are important goals, but don't lose sight of retirement just because the first goal in your timeline is establishing that emergency fund. Work them both into your plans so that you have an idea of where you stand. Again, retirement is one of the biggest accumulation goals that you're going to have. And it should really be at the forefront of your financial strategy. So being aware of that goal as you accomplish these other goals is going to help you in your overall financial plan. What are your goals? Are your goals things like a new car, a new home, college for your kids, retirement, a vacation home, or just the emergency savings? Your goals and timelines are the biggest factors in how you allocate your money. Each goal must be considered for creating the appropriate asset mix. You also need to take your risk tolerance into account. You can set targets and then rebalance the portfolio periodically to adjust as needed. If you want your money to grow, and who doesn't, your allocation would likely include investments that target growth, such as stocks. Now, if you're less inclined to take risks, you may want to allocate it more conservatively. Everyone's got their own opinion about what their most important goals are, and that's the way it should be. But I'd like to point out that saving for retirement is probably the most important goal, and it's going to be the most important to most people. Most of us are going to be spending 25 to 30% of our lifetimes retired. So there's a growing insecurity about Social Security's ability to fully compensate future retirees, and therefore being prepared for retirement is important. To ensure that you've got enough for retirement, most experts recommend saving at least 10% of your income. But this is not a one-size-fits-all scenario, and a 40-year-old who's just starting to save for retirement might need a different strategy than, say, someone in their 20s. Emergency savings should also be a high priority. Make sure that you have at least 3 months worth of living expenses in case you become unemployed, seriously ill, injured, or disabled. And if you have kids, you'll probably want to prepare for their college education costs, along with the timeline. As an FYI, for a public 4-year college, in-state students paid tuition and fees averaging $10,440 a year in 2019 to 2020, an increase of 2.3% from the previous year. Yearly tuition and fees at a private 4-year college reached $36,880 for the school year of 2019-2020, which is an increase of 3.4%. If you want to buy a new home or make an investment into a vacation home, you should have 10 to 20% of the purchase price available as a down payment, that vacation home. So these are some of the common goals that people set. And so after you've decided on your own goals, it's time to start creating and thinking about that timeline. And then in addition to that, how are you going to allocate your assets to achieve each goal? After you've established your goals, the next step is determining your personal tolerance for investment risk and how you can make it work within that timeline that you've created. So your risk tolerance will depend a lot on your timeline. If you have 20 years before you need your money for that particular goal, you may want to consider investing more in stocks because you'll have time to ride out short-term fluctuations. You need to keep in mind, though, that holding a particular stock for 20 years comes with no guarantees. You may still lose that money invested. If you need your money in 5 or 10 years, you may want to be more moderate. A lot of investors choose bonds and money market instruments for shorter term goals, with a more moderate investment into stocks. Why? Because they need that money sooner. They aren't necessarily willing to ride out or go through those short-term fluctuations. As you approach the time frame when you'll be liquidating your investments to apply them towards your goal, you need to remember to review your allocation. If you haven't accumulated enough for your goal, you may want to consider a more aggressive allocation to try and make up for that shortfall before you accomplish your next goal. The important thing is to always consider how much risk of loss you as an individual are comfortable with. So let's look at a few examples of common goals and timeframes so that you can think about how you might allocate your assets to pursue these financial objectives. We've set up some sample portfolios for these 4 types of goals. Now, to clarify, these are just examples and they are not meant at all to be specific investment advice. The goals fall into 4 broad categories with varying time horizons. Emergency funds as soon as possible, major purchases within the next 5 years, accumulation goals for retirement or kids' college expenses, and finally, wealth preservation, which usually includes retirees who hope to live at least another 25 years. So let's start off with emergency funds. Setting aside money for emergency funds is an example of hoping for the best but planning for the worst. Experts recommend having emergency funds to cover 3 to 6 months of living expenses just in case you lose your job, are involved in a car accident, or you have some unforeseen thing that comes up. These funds are to cover necessary expenses, things like food, water, electricity, heat, rent, mortgage, insurance, healthcare costs, and debt payments. You can do without discretionary spending, such as entertainment, dining out, shopping, gym memberships, subscriptions like Netflix, and maybe even cable. If you haven't already, set up a budget to determine what your expenses are. I recommend doing this as soon as possible. Investing your emergency fund can make them more difficult to access if you have an emergency. Many investors start with a high yield savings account because the money is liquid, accessible, and insured by the FDIC. However, because interest rates on savings accounts are relatively low, often below inflation rates, you may want to keep only 2 to 3 weeks worth of expenses in that high yield savings account and consider other options with higher return potential for the rest of your emergency fund. Some of these options include CDs, money market accounts, money market mutual funds, Roth IRAs, index or ETFs, and HSA accounts, health savings accounts. Be sure that you read the fine print so that you know about any restrictions or penalties that may apply to each of those accounts and options that I just listed out. Deciding where to keep your emergency funds is a personal financial choice for you, and you need to do your homework before deciding which option to consider and make sure that you understand the potential risks and rewards associated. Let's talk about a major purchase. If you are planning to make a major purchase like a home or a car in the next 5 years, you may want to consider a moderate growth portfolio. In this hypothetical example, 60% of your money is invested into stocks and 37% into bonds. The remaining 3% is allocated to cash and Treasury inflated protected securities, or TIPS, which are bonds issued by the US Treasury to help guard against inflationary impacts. When you're planning ahead for your kids' college or other goals, at least 10 years down the road, you probably want a portfolio that's a little bit more aggressive. You'll take on more risk, but have the potential for more reward. The longer timeline should give you the opportunity to ride out any short term fluctuations that you may encounter. In this hypothetical example, for an aggressive portfolio, 5% of the investments are in bonds and 95% in stocks. Now, do keep in mind, though, that you may want to modify your allocations as you approach the date for assessing your investment for your kids' college expenses or whatever goal you've set for that time frame. If your 10 plus year goal is for your own retirement, you may want to add tax deferred accounts into the mix, such as 401ks and or IRAs. A conservative portfolio is often used for wealth preservation and can help retirees make their savings last. This hypothetical allocation is designed to do just that, with primarily conservative instruments that can help protect what you've accumulated over the years. It has 73% invested in bonds, 20% into stocks, 2% into cash, and 5% into Treasury inflation protected securities. Tips. It may be 25 years before you plan to retire, but you could live another 30 years or more after that. The goal of a conservative portfolio is to provide investment income and help guard against the risk of inflation. So now let's talk about risk and how you may want to manage it. These two charts give you an idea of two sample portfolios and their performance over the same 30-year period. The average return for the all-stock portfolio was 9.97%, and its risk level was relatively high, 17.19%. The portfolio of 60% stocks, 30% bonds, and 10% cash or cash equivalents had a slightly lower return of 8.37%, but a much lower risk level of 10.8%. It's always important to remember, though, that past performance cannot guarantee future results. However, this example helps illustrate how important asset allocation can be in managing risk. Allocating your assets is not a one-time decision. You need to recognize that you may need to make adjustments based on what's going on in your life. Maybe your job has changed, you're getting married or divorced, or you have a kid. These are just a few examples of the kinds of changes that can signal that it's time to review your financial goals and your allocations. I recommend that you review your asset allocations at least once a year, even if there haven't been any big changes in your life. You might discover that market performance has shifted your allocations without even you realizing it. As I mentioned earlier, you also need to consider allocation changes as your timeline shortens for certain goals, such as your kids starting college or retirement. If all of this seems a little overwhelming or confusing, you are not alone. There's a lot to digest here. You may want to seek help from a financial professional, and I'd be happy to help you if you're in that situation. A financial professional can help you establish your objectives and timelines and make recommendations that should help you pursue your goals. There's also a lot of just free helpful resources out there that you can use and learn more about allocating your investments to achieve your overall goals. In addition to a financial consultant, you may find that professional or business groups can be a helpful networking and information tool. Some people have learned a lot by joining an investment club and hearing about others' plans and experiences. And don't forget about your public library, as well as reliable, trustworthy online resources, where you can find valuable investment publications and books. The more information that you can arm yourself with, the better prepared you'll be. We've covered a lot of ground today with a detailed look at how asset allocation can be used as a very important tool in determining your financial future. I hope you'll apply what you've learned to your own financial plans. And I hope that this helps you achieve or even surpass the goals and timelines that you have set for yourself. Thank you for being here today. I'm happy to answer any questions that you may have. Just use my contact info in the next screen and reach out to me. Thank you so much.